speaking of heating up, inflation seemed to heat up in the month of January with the latest reading on the Consumer Price Index. Producer prices came in a bit better, offering some hope for your favored inflation gauge, PCE. But given that inflation spiked in the first quarter of last year, and now we're seeing the uptick again in January, given that there was hope we would see easier comps that would provide some progress on the inflation front, to not see that now, are you worried that inflation is indeed heating up, or is this some sort of seasonality we're seeing at the start of every year?
Well, let me start by saying I get paid to worry, so I worry all the time about everything. I will say that with inflation, one of my expectations for a long time has been that we would see progress from the very high levels that we had in the middle of the pandemic, and that's exactly what we've had. And then once we got to September and we were getting closer to our 2% target, I didn't expect that the progress would go in a straight line. So bumpiness and a data point here or there that might send a different signal is not something that's super surprising to me. I think the biggest question right now is whether that data point represents a new trend or just a bump in the road. And that's what me and my team will be looking at over the next several months to make sure that we draw the right conclusion from those January numbers.
Yeah, and that January reading came before any tariffs or any changes in policy. And the minutes released from your last policy meeting this afternoon with a 3-week lag showed that you and your colleagues are worried about potential changes in policy, whether it's tariffs or immigration, and that could pose a risk to higher inflation. How are you factoring that into your outlook for inflation?
Well, look, I think that's a very good question, and I'll just say it's very difficult to factor all of these potential changes in. And I want to emphasize the word potential. For many of these policy areas, we don't have a final policy in place. So right now, we're just kind of trying to keep our eyes on the ball and make sure we understand what's going on. Until that's the case, though, I had an outlook that 2025 would proceed at a very positive level. We'd see solid growth. We'd see inflation continue to move to 2%. We'd see labor markets stay solid. Now, all this potential change, though, means that the confidence band, the precision of that estimate, in my mind, has reduced somewhat. And we'll just have to see how things play out over the next 3 and 6 months. And as we get more clarity on exactly what the policies are, then I'll have a better sense of what's going to happen in the economy. One thing I should also emphasize here is that in addition to some of the policy change that people are expecting might be inflationary, there are others that could go the other way. For example, we've heard a lot from my contacts about the prospects of deregulation, spurring a lot of investment that could increase productivity in ways that could show progress in terms of growth without putting that pressure on. So the details are actually going to matter here, and that's really what I'm going to wait to see.
I know you just said the details are going to matter here, and we need to look at the holistic picture. But to be sure, as the minute said, you are looking at these policies and think they could potentially push inflation higher, correct? Yes or no?
They could, and they could go the other way as well. It's really the whole mix because, again, I've talked to a lot of business leaders who are quite optimistic about what's going to happen on the regulatory side in particular. And they think those effects may actually swamp what happens in other areas. And so I don't want to presuppose anything at this point. As I said to start, I'm worried about everything, but I definitely want to make sure that before jumping to any conclusions, I see precisely what the policies are.
In talking with businesses on the ground, given that consumers are fed up with inflation, probably not going to be tolerant of more price increases, when we do see tariffs, do you think they will get passed on to consumers, or businesses are going to be forced to eat the majority of that? And what does that mean for the overall inflation picture? Does that get bottled up sort of in the supply chain on the business end at the expense of profits? How do you see that playing out?
Well, this is a question we've been asking everyone because the notion that there would be tariffs have been out there for a while, and we wanted to get a sense of what people are thinking. So in our surveys and in our conversations with leaders, we've asked them what are they likely to do. And what they've all said is that our first best choice would be to pass on this to the final price. But I would just say, and you noted this as well, we've already had a period of intense inflation, consumers may not have an appetite to do that. So we will have to see sort of how that interplay occurs, and that'll really determine what the final outcome is. I do have a sense. So I talk to a lot of business leaders as well, and what they tell me is that their customers are pretty much tapped out. So there is some uncertainty about what the final landing point is going to be. I think it's actually quite different than what we saw in 2017, when we hadn't had that inflation and consumers had a little extra space to be able to take on some price.
So, are you worried that you should be more restrictive now? Do you think you cut too much last year?
So I don't think we've cut too much. Look, I think we are still in a restrictive posture. That's what we need. And as inflation gets closer to our 2% target, the ideal way for our policy to move forward would be for us to get to our neutral level right at that point. That would mean we couldn't wait until we got all the way to 2% to start reducing our rate. So what we've done is appropriate. Now, of course, now we have to see sort of what that means for how the economy is going to evolve. And that's what we're doing now. It's one of the reasons why I've been really comfortable with the idea that we would take a pause and wait and see how the economy is evolving, and then use that information to guide what our policy should look like over the next several months.
Just to your point, you've said that you want more clarity on policy changes before deciding which direction to go with policy and how fast. But given that this administration is constantly going to be rolling out policies over the course of this year, what is the prospect that you remain on hold for this year entirely and that there aren't any more rate cuts this year?
So I don't have insights as to all the things that the administration may roll out. And if it is a year, then I think what would happen is that it would be take a longer time and it'd be slower for us to get all the way back to our neutral level. But I don't know what the future will hold, and I'm just going to be ready to take it on board as things happen. I do
So
expect that
cuts are
we'll
still on
get
the
some.
table?
Say that again.
So cuts are still on the table?
Sure. Everything is on the table at every meeting. I do think that I go into every meeting open to the possibility that we might take any kind of action based on what the data at the time are. So I'm not taking anything off the table. I'm not putting anything extra on the table. I would just say that we're going to let the data guide how my team looks at it, and then I'll go into the meeting with a view based on that as to what the appropriate action will be.
The minutes also noted that some officials are in favor of slowing the balance sheet or perhaps even pressing the pause button if we were to see any hiccups surrounding the debt ceiling. Are you in that camp? What are your thoughts on that? How did that discussion sort of play out within the meeting?
Well, look, first, I want to say I'm very supportive of the idea of getting the balance sheet down in size away from its emergency level. And we've made good progress on that. The reality is that as we do reduce the size of the balance sheet, we get to that threshold level. There's some threshold level where we're not going to want to reduce it any further because it'll affect volatility in money markets and other things. I think we're getting to that level, close to that level, and there's not precision on that. And given that, I think it's going to be appropriate for us to be more cautious today and moving forward than we have been in the past 6 or 8 months. The debt ceiling is one factor that comes into that, but there are others as well, including how banks decide to deploy capital across their investment instruments. So this is something I want to look at more broadly and make sure that we are paying attention day to day and make sure that we don't go too far and create volatility in the marketplace that could potentially be avoided.
And President Bostic, we'll have to leave the conversation there, but thank you so much, as always, for your insights. So appreciate it. Hope to talk to you again soon.
I look forward to talking to you, and hopefully it'll be back in the sunshine.